today. I'm Susan Frocht and wanted to just welcome you to our Genscape webinar. We'll be focusing on ERCOT and the expanding DART spread and what it means for your buying and selling strategies. Feel free to ask us questions during the webinar by typing them into the box that you'll see to the right of the screen. We'll address those as time permits, but we're glad to certainly follow up with you after the call as well, and you can just either give us a call or shoot us an email either way. With that, I'm going to hand it on over to Hudson Gilmer. Hudson?
Thank you, Susan, and thanks to everyone for joining today. So as Susan mentioned, we'd like to spend some time sharing with you some of the observations we've had of market trends in ERCOT. I'll just jump to the slide. Doesn't seem to be advancing here. Okay, there we go. Just a quick agenda. So we'll start with a quick intro for Genscape for those of you who may not be familiar with us, and then really jump into the meat of it, which is talking about the historical trends of DART spreads in ERCOT since the market went nodal on January 1st, 2011. We'll talk, and I've got with me Eric Palmer, who heads our ERCOT analyst team. We'll go into some of the root causes and the outlook for the DART spread going forward. And then I think what really gets interesting is implications for your buying or selling strategy. And then we do want to introduce ERCOT Power Buyer, talk a bit about the model that's built upon and the methodology that we use to analyze this market. Eric will walk through today's report just to explain what clients receive and talk a bit about how different type of participants use that information. So very quickly, just background on Genscape. Genscape is a global provider of fundamental data in various commodity markets, including power, natural gas, oil, and agricultural markets. For those of you, obviously, who are in the power markets, you're probably most familiar with the product that you see kind of depicted on this map here. It's what we call Power RT, and it was the first product that the company came out with, which uses a patented monitoring technology to measure the real-time output coming from the majority of large power plants across the country. So this gives us, of course, kind of a unique visibility into what's happening on the power grid, not only at the plant level, but even down to the transmission line level. And if you look at the large market participants across the U.S., 25 of the top 25 power trading firms are clients of Genscape's. More recently, we've developed products like Power Buyer that are geared more towards what we call commercial market participants, folks like retailers, like smaller utilities, even industrials who are not pure financial traders, but are buying or selling power to support their core business. And since we launched ERCOT Power Buyer back in April, we now have over 20 of the largest retailers using that product. We have many merchant wind and other merchant generation owners using it, and also some of the largest industrials in ERCOT. And we'll talk a little more about kind of how they can use that. But that's one of a number of products that Genscape offers in the what we call market intelligence or Power IQ family of services. They cover all of the ISO markets across the country: PJM, MISO, ERCOT, NEPOOL, New York, California, and the WEC. And we provide daily fundamental reports that do demand forecasts, price sensitivities, and really detailed analysis of market drivers, generation, imports, congestion, and so forth. Hopefully that's familiar to most of you, but just want to provide a bit of background there. So then turning really to the topic of today's webinar, We're focused on the DART spread, and maybe just a bit of terminology before we go into too much detail. DART stands for day ahead minus real time. Obviously, ERCOT provides market participants with two markets, the DAM or the day ahead market and the real time market, that they can participate in to bid their load and generation. And if you think about it, these are kind of intertwined, but what we're really talking about today is the fact that kind of contrary to your expectations, the price difference is fairly significant between ERCOT's day ahead and real-time market. And if you think about kind of Finance 101 and a capital asset pricing model, the principle there is that in an efficient market, asset price differences should be explained by differences in their underlying risk. So in other words, you're willing to pay more for an asset that has less risk than you would for a comparable asset that has more risk. And if you think of the day ahead and the real-time markets as two assets that you're buying or selling into, the price difference logically ought to be explained by the difference in risk. So let's look at a few of the more mature Eastern markets. PJM, most liquid hub is West Hub. And what you see is basically year to date in 2012, the DART spread is very close to zero, $0.19 or 19 cents. And there's also a very small difference in volatility. And the way that we're measuring volatility here is we're calculating the standard deviation of the hourly real-time price and subtracting the average standard deviation of the DAM price. So logic would tell you the day ahead would be more volatile than the real-time. Perhaps somewhat surprisingly, that's not the case in PJM. There really is not much difference at all. MISO makes a little more sense. You have a DART spread of a little over $1, and you have a difference in volatility where that dollar premium in the day-ahead market is justified by a greater volatility in the real-time market. And then you can see ISO New England, Mass Hub, and New York's own G similarly. So how does that compare to ERCOT? If we add in ERCOT, you see that the average DART spread over that same period, January 1, 2012 to the end of October, is nearly 3 times that of the MISO market, which is the highest average DART spread. And that would make sense if you had a much greater volatility in ERCOT's real-time market than you did in the day-ahead market. But you actually don't. Maybe counterintuitively, it's actually negative. So this tells you that the DAM has been more volatile than the real-time over this period. So it really kind of leaves you wondering, okay, what are the drivers that cause ERCOT to be so different from those somewhat more mature Eastern markets? And to try to get to the answer of that, although we'd love to get your thoughts as well, I'm going to turn it over to Eric Palmer. Actually, before I do that, let me just show you a little bit more about the price history, just expressed in a slightly different way. So this graph you're looking at here shows you the average LMP for all 24 hours since January 1, 2011. So basically since the market went nodal for both the real-time, which is in blue, and the day-ahead, which is in red. And you can see that the prices track fairly closely to each other. You will see that there were a couple spikes here. For those of you who have been in the market for a while, you'll recognize that I think it was February 2nd of 2011, we had that freak ice storm that caused price spikes. So that explains this spike here. And then obviously we had record heat and prices not this past summer, but in the summer of 2011, which explained the spike here. But when you're just charting against average LMP, you see that real-time and day-ahead move pretty closely together. Now I'll overlay the DART spread. So this is the green triangles here represent the average monthly DART spread measured against the right y-axis over that same period of time. And then the black dotted line here is the 3-month average of those DART spreads. And so you notice a couple of things really jump out at you first. One is that the DART spreads are significantly positive. You've got them growing, but pretty much above zero, with only a couple exceptions. One is that ice storm that I mentioned earlier, which really caused real time to spike well above day ahead. And then you also see an anomaly here in March of this year when you had almost record amounts of generation offline under maintenance and very low capacity margins as a result that caused some real-time spikes. But really, if you take out those anomalies, you see that the DART spread was positive pretty much over this entire period, and the trend is increasing. So you see a fairly pronounced upward direction to the point of where over the last 3 months you're seeing an average DART spread of 15% or more, and 30% in August alone. And if you compare the 3 months prior to August 1st to the 3 months after August 1st, you see that the 3 months after August 1st were 60% higher. It was an average of 15.5% premium of the day ahead over the real time versus an average of just under 10% before that. So now we'll move it over to Eric to talk about some of the drivers behind this.
Thank you, Hudson. So some of these drivers, particularly, I'm just going to start with, ERCOT is a young little market, and currently the day-ahead energy sold is roughly only approximately, 50% of real-time load. And, while this number has increased since ERCOT went nodal, in 2011, for the most part, we saw, day-ahead clear demand roughly 35 to 39% of real-time load at the peak hour. Now we're seeing closer to 50% at the peak hour, or maybe even a little bit above in 2012. So, basically less participation is driving higher day-ahead clears. A large percentage of generation is committed bilaterally, either through physical power hedges or power purchase agreements, sold years out in advance for financing reasons. And, when you have units that are bilaterally hedged, you're not going to offer them into the dam because you're essentially going to sell that power twice. So, essentially, that generation is going to run real time and not offered into the dam. Dam participation is not mandatory. On peak summer days, units refrain from selling in the day ahead, while load tends to bid into the day ahead to avoid risk. Anytime you have a fear premium, essentially, where prices could spike, you're going to have more load bid into the day ahead to cover that risk, and you're going to have less generators wanting to sell that excess capacity or energy in the day ahead market, chasing that higher real-time spike.
Just to add to that, so this obviously is a unique market structure attribute of ERCOT. Most other markets require generators to bid into the day ahead, but given that ERCOT doesn't require that, from a generator's perspective, they'd rather have the flexibility of bidding into the real time, because if they bid into the day ahead, they're committed. They've got a committed position. If the unit, for whatever reason, can't run the next day, they're on the hook. So all things being equal, they'd prefer to bid into the real time versus the day ahead.
Correct. And right now, we still have a growing system-wide offer cap. On August 1st, we increased from $3,000 to $4,500 per megawatt hour. And really, going forward, it's only going to go up. to $5,000, $7,000, $9,000 per megawatt hour is, kind of the expectation going forward. And, as a result, you're gonna have more of a fear premium where, loads do not want to be short in times of, stress on the system, and generators want basically to be long during that same period. So, the high price caps definitely drive load to the dam to avoid the risk, and really drive the generation to the real time to capture that volatility.
And just to add a little bit to that, we work with a lot of retailers, and sometimes it's not necessarily their choice that they want to be in the day-ahead market. They recognize there's an economic benefit to their margins of going to real-time or having greater real-time exposure, but often they're constrained by their credit sleeves or by their risk policies. And so part of what we hope this does is kind of drive an active dialogue around, is the risk policy appropriate given the reality of these markets, or should it perhaps in some cases be revisited?
Great. Continuing on, ERCOT, is a very transparent market, and in the BAL-day market, there's significant market participation within generators, changing schedules, changing run times, start times, and end times, ending earlier than expected or later than expected. And because of this, because it's so visible, on days where there's a perceived capacity shortage, any uncommitted generation can schedule itself online, and if it's available. And because of that, a lot of times you'll have a high day-ahead clear, and then the next day, that generation will turn on, and the real time will clear far below where the day-ahead cleared the next day, or it may just prevent a real-time spike, and in which case it will keep the DART spreads pretty minimal, or preventing them from becoming negative. Another potential driver is the wind volatility. ERCOT now has over 10,000 megawatts of installed wind capacity, and excess wind is priced extremely cheap. And when wind in the real time comes in above the previous day's forecast for that day, it really suppresses the real time prices in that BAL day. And of course, this works both ways, where the wind forecast, the wind can actually come in well below expectations. But, that being said, if you see a trend of wind coming in below a forecast, there can be some, active market participation where extra units, become scheduled online and can help mitigate some of that real-time upside risk. And then finally, increased generator preparedness. This past March and April, we had a significant amount of megawatts in outage, preparing for the summer. After this past summer, units were brought out of mothball. Most companies did not want to be short the summer as a result of what we saw last year. So if you have plenty of generation online and available, and you don't have record-breaking demand, loads are still going to bid into the day ahead. Generators will run real time, and you're going to have a widening DART spread as a result.
So before we move off this, maybe, Eric, if I could ask you to kind of net out all these factors. I mean, it feels like, obviously, the market will mature. Yes, it's young, but probably the dam participation will increase over time, which may, on its own, kind of cause DART spreads to reduce. But it feels, if I understand correctly, like the other factors, such as the increasing system-wide offer cap and the other factors you went through, would offset that, or more than offset that, in terms of causing that high DART spread to persist and possibly increase. Is that fair?
Yeah, I mean, there is plenty of reasons why the day ahead will always clear above, just because of that high offer cap. It's the fear premium and the fear of a $9,000 price print. Will pretty much drive. There will always be participants that will solely participate in the DAM and will not have any real-time exposure as a result of that. So you're going to see DART spreads continuing to widen, or at least not shrink very much as a result of that.
Thanks. So I want to move then a little bit to what are the implications in terms of participant buying strategy or selling strategy. We call it power buyer, but the reality is we actually have a lot of clients who use that product who are selling generation. So staying on the buying side, if you look at this graph, what you see really is kind of a spectrum of options if what you want to do is have a fixed exposure to the real time. On one extreme, and there's actually a lot of participants who are on this extreme, you've got minimal risk, basically zero exposure to the real-time market, and maximum price. So highest dollars per megawatt hour. And on the other end of the spectrum, you've got full exposure to the real time. So you're bidding all your load or all your imbalances into the real time, and based on what we shared with you, that would net you the lowest price just based on kind of a fixed strategy, but the highest risk, of course, the highest exposure to those high real-time caps. The good news is there's actually another option that helps you to move off this curve. And so I guess just before I go there, you can adjust your blend, your exposure to the real time from 0-100 to 100-0 or anywhere in between. And essentially that's what this line is showing you. That's your range of options for a fixed blend strategy. But by using Power Buyer, by using the fundamental price forecast that's offered by Genscape that gives you hourly price forecasts for the day ahead in the real time, looking at that same period, essentially what clients are able to do is achieve an average buying price that is below even 100% real-time exposure, but with basically with half the risk. So by only putting about 50% of load in the real time, obviously on an hour-by-hour basis using the daily reports, they're able to get an average price that's below 100% real-time exposure. And conversely, for those who are using Power Buyer to sell generation into the market, essentially they're able to get an average price for their generation that is $41 per megawatt hour, which is above even the price of putting 100% in the day-ahead market. So the logic, of course, for someone who's looking to sell load is they want to capture any real-time upside risk. And when Eric walks through the reports, he can explain a little more about how that's done. So showing this in a different way, basically what this chart is doing is showing three buying strategies. Putting 100% of your load in the day ahead, or 100% of your imbalances in the day ahead, 100% of your load or imbalances in the real time, or using Power Buyer to optimize on an hour-by-hour basis. All the graphs we showed before were just for North Hub, but this shows you that the results hold for Houston, South, and West as well. So you can achieve savings of basically between 10 and 12% versus putting everything in the day-ahead market, and achieve essentially about the same average cost as putting everything in the real time, but only have about half the exposure to the real time, so about 50% of hours in the real time. And then this chart essentially is showing the same information from the perspective of someone who's selling, like a merchant wind operator or an IPP. So here again, you can see just for North Hub, you can achieve revenues nearly 13% higher than just putting all your generation into real time, but only put about half your hours in real time. So how do we do that? What is Power Buyer? What's the model behind it? This is not a statistical model. There are other sources where you can get hourly price forecasts for the day ahead in the real time based on neural nets, based on just looking at historical prices and similar days. But what Eric and his team do on a daily basis is really replicate the way that ERCOT itself is clearing the day ahead in the real-time markets. It's a security-constrained unit dispatch model. We've been doing this for over 10 years, and this is the 6th generation of model that includes over 1,800 transmission lines and transformers, includes over 1,000 bid blocks, all the generators that are 90 plus gigawatts of generation, a lot of which we're directly monitoring. We're doing our own demand forecasting. So we've got a neural net that does a raw demand forecast, but we also have a team of meteorologists who then are fine-tuning the output of that. And the result actually outperforms ERCOT's next day demand forecast when we're measuring mean average percent error, or MAPE, by nearly 7%. We also are modeling, and again, Eric will go into kind of the process on a daily basis, but monitoring the historical bidding behavior of all generation and updating that supply stack daily based on seeing which units ran, which didn't run against the day ahead in the real time. And we've also got a proprietary wind forecast. And then a big part of what Eric and his team are doing is congestion modeling. So looking at scheduled line outages and other transmission outages, understanding from the model what the impact or potential impact is going to be on congestion over which hours, and incorporating that into the scenario runs. And then the results that we'll walk through for you is daily reports that provide a summary of drivers, risks, recommended buying strategy for both the day ahead and the real time. And one of the important things we're doing is also running an upside risk for the real time, essentially to provide a warning to stay away from the real time during specific hours when there's upside risk. So Eric, maybe you can just run through briefly the daily kind of recalibration process and modeling process.
Absolutely. So our ERCOT team gets in to the office around 4:30 Central Time, and really what we do when we start, before we start modeling, is we have to recalibrate the model. And before we start modeling the BAL day and the next day, you have to really find a good starting point. And the best starting point is what actually happened the day before. So what we do is we take actual, demand, actual wind, the transmission line outages. We put them into our model, and then we take a look at the day-ahead commitments for that day. We utilize actual Genscape monitored data to see what the actual power plants were doing at the time. And what we do is we go into the model and we model what exactly happened the day before. We match prices and power flows. And that way, we can see how the units actually ran and check our assumptions to what exactly went on the previous day. Once we're finished with that, we'll take all that data, our stack data, and move it over to the BAL day. We'll get an updated load forecast for the BAL day from our meteorologist. We'll get an updated wind forecast, and we'll input that into our model. And once again, we'll take a look at the dam commitments. We'll take a look at what units are actually running, look at the capacity number, see how much gen is actually online, and we'll input all the new transmission outages, and then we'll go and model the BAL day. Once the BAL day is finished, we'll take that stack data and move it over again to the next day. And once again, input all the new variables, the demand, the wind, transmission outages, and we have a very experienced ERCOT team. We've been watching the trends of which units tend to jump in and jump out of the day ahead in the real time, and we'll make our best assumptions on what's going to happen unit-wise for the next day, and then we'll model the next day. And we do the same process for the day-ahead market, just using the day-ahead energy sold. We'll match what actually happened for the current flow date, move the stack over to the next day, input the new demand, make generation change assumptions, and model the day ahead. And that's how essentially we get the next day real-time and next day day-ahead market forecast.
Yeah, and I think that's an important point. Just because ERCOT is so unique in having such a difference between the day-ahead and the real-time, these are modeled as completely separate models, actually by separate analysts, and that's able to capture the price differences over the course of the day. Maybe the best thing to do then is just actually pull up and walk through an example report, and we'll use the report that went out this morning for tomorrow. Okay, I think everyone can see this now. So this is this morning's Power Buyer report. I'll let Eric walk through it, but as you can see, the separate tabs for each of the four hubs and separate tabs for demand, generation, and performance. We'll just stick with North Hub for now.
Okay, thanks, Hudson. So basically, the Power Buyer report starts with a brief commentary. We like to touch upon the BAL day, anything major happening in the BAL day. There was some bearish congestion this morning, which we touched upon, and there were some 345 kV line outages that were responsible for that this morning. And we talked about it in our commentary. But basically, the first little paragraph here is the major points of what we expect the BAL day and the next day to do. We talk about what units stepped in and out of the day ahead, how much excess capacity there is in the BAL day and for the next day, any new major transmission line outages, differences in demand forecasting, peak demand forecast for the BAL day and next day, and finally a recommendation for a purchasing strategy for the next day. As you can see, we have a Genscape demand forecast and an ERCOT demand forecast. Everything is basically laid out. We have a Genscape BAL day forecast and the next day forecast overlaid on the same graph, so you can see the changes day over day. To the right, it's a graph of our next day ahead and next day real-time base case forecast. And also, we overlay the BAL day dam solution for the North Hub as well. So these two lines are the next day dam base case and the next day real-time base case, the BAL day dam solution. These bars in the back are the forecasted dart spread. They correlate to the right axis. As you can see, for the midday hours tomorrow, we're showing a negative dart spread. As we move down, we can see the actual forecast, the numerical numbers for all 24 hours. We have a forecasted dark spread, and we have a just a plain market call, which market is cheaper to buy in for that hour. And if it's within if the real time is within plus or minus of $1 of the day ahead market, it's a neutral. We just say, go buy the day ahead, because there's no point in risking, risking the real time for less than $1. Now down here, what we have is a real time upside risk, and this is actually one of the great features of this is that we actually run a real-time model run with 1,000 megawatts higher demand, and really it's to judge the stack. Is the stack all wind? Is it more expensive steam generation, or is it just basically cheap generation out there? And essentially we assign a level to the price change. So a low real-time upside risk would be a real-time price with 1,000 megawatts higher demand with less than a 10% upside. And as you can see down here, we actually have it laid out. So a medium real-time upside risk would be 10 to 20% upside on the real-time price. High would be greater than 20%. As you can see tomorrow, we do have some high real-time upside risks over the midday hours when the wind dips. And finally, we have a risk-adjusted market call. And essentially, this is a recommendation based on the risk level and the forecasted price of both the day ahead and the real time. And really, it's calculated based on our historical forecast and actual data, and it's designed to give the highest cost savings. So as you can see, for hour ending 16 tomorrow, we do have a higher day ahead price than the real time price, but we have a high real time upside risk. So to pay that extra $1.32, you might as well just go to the day ahead market and reduce that risk. And this risk-adjusted market call, it really avoids you from overpaying in the dam on a regular basis, and it also reduces the number of real-time blowout hours, which is we find as anything $50 above the day-ahead price. So essentially, that's really where your cost savings is going to be. As you can see, for hour 19 tomorrow, we do have a high real-time upside risk, but we also, because the dam is so much more expensive than the real-time during that hour, we're still saying go to the real-time. These other boxes are just, the markets, the Genscape wind forecast, the ERCOT Val-Day wind forecast to show the changes in wind day over day. You can see the large increase in wind for tomorrow. And then we have two other tabs for each hub. We have a generation tab, which is system-wide. We have essentially the real-time supply stack for tomorrow. This is what we have in our model. And then we have a day-ahead market supply stack, which looks a little choppy, but it's because it's roughly only 50% of the real-time load, and people can offer in whatever hours they want, so or sell or purchase whatever hours they want. As you scroll down, you have a next day generation to load ratio. This is a great graph, great feature of the product. You can really see that the surplus in the west generation to load is very high. You're probably going to have some bearish west congestion in these hours. Maybe probably won't have really much congestion here. And then once again in the evening, you'll have risk of bearish west congestion. If it's sub 1, if it's a below a 1 ratio, you'll probably have some bullish west congestion during that time. And obviously a lot of the constraints are based off of localized wind farms, but it's a great little general consensus. And you have the other zones as well. And then finally, this is the outage graph. It shows what the amount of units that we have that we're seeing shown in outage for the next day. So there are still quite a number of units in outage right now. It is outage season, so this number was actually a lot higher back in last March. It was at least double. So. And then finally, for each tab, we have a performance. And basically what we do is we go and we, full transparency. This is for 12.4 for the North Hub. we're showing what we forecasted on Monday for Tuesday, day ahead and real time, and our forecasted DART and our risk-adjusted market call. So this is what went out for yesterday on Monday, and this is where prices actually came in. And we basically just go through and tell you, did we send the correct signal? This is what the correct market to buy was. Were we right or wrong? And then our upside risk. So as you can see, we didn't get every hour, but big hours, everything is conditionally formatted. The DART spreads for the hours were pretty good.
And so essentially this summary box on the bottom shows you savings had you used Power Buyer and followed those hour-by-hour buying recommendations, how you would have done versus the OTC, versus the DAM, and versus the real-time. And what you can see, if we just look at the 24-hour weighted average, you would have saved $2.55 per megawatt hour versus going to the OTC. You would have saved $2.62 per megawatt hour versus going to the DAM for everything. And you would have been slightly worse off than had you put everything in the real time by less than $1 per megawatt hour. But
the goal of this product is essentially to reduce your risk while capturing most of the savings, if not more, than a entirely day-ahead market strategy or a real-time strategy. So, and that's essentially the report. We also have it for the other hubs as well. The generation is system-wide, so that's the same across all. But as you can see, the prices do change per hub. So that is Power Buyer. So
just coming back to this, essentially clients who get Power Buyer get those daily reports, just like the one that Eric walked through with the DAM and real-time hourly pricing, the risk-adjusted market calls, and then the analysis of the drivers. There's also an XML data feed that's available as part of the service. We do have some customers who actually just automate the daily decision or just pulling it into their own data warehouse or systems for history. And it's not on a per-user basis. It's an enterprise and a site license. We do have a separate service for ERCOT that we call Power IQ that goes into a little bit more detail. It also includes, instead of just informing that daily decision for tomorrow, should I put my load or generation into the DAM or the real time, it also includes Valday reports and a recap report, which essentially explains what happened yesterday and why. It also has a lot more detail around congestion analysis, kind of down to individual lines and risks to nodes and so forth. It not only has the hub pricing, but also has the load zone pricing and some other sensitivities like gas sensitivities. And also importantly, it includes daily analyst access via IM or phone. And there's a morning private kind of one-on-one briefing call with the analyst to just run down. There's a lot to digest here, but to kind of run down the day-over-day changes, the big drivers, the risks. And those tend to, you get a nice rapport with the analyst where it's kind of specific to the way an individual participant is trading or where their assets are. So, as I mentioned at the beginning, we've had a great response to the service since we launched it back in April of this year. We've got over 20 retailers using it and a number of munis. And they're, as you might expect, using it to determine where to put their incremental load, to where to put their imbalances. Some are their willingness to go into the real-time kind of adjusts or ranges from client to client. We also have a number of large industrials who use it, and they're, in many cases, they look like small generators. They may have significant cogeneration, and they can run that generation or curtail their load and actually supply power back to the market. And so this is kind of informing their decision when to curtail, when to run their generators. And also, because we've got a very accurate demand forecast, we can help inform their decisions of when to curtail their net consumption off the grid to avoid 4CP demand peaks and the demand charges that come along with that. And also, as you may have noticed in the summary, there's a capacity forecast, which is giving an indication of how much surplus capacity ERCOT has going into tomorrow. And that can be kind of a red flag if it's very low, below about 1,500 megawatts, that there may be demand response events, or even below about 3,000 megawatts. So some of our industrials are using that to really give them kind of operational advance notice of when they may have to ramp down their lines. And finally, we've got quite a few merchant wind operators and generation owners, merchant generation owners, who are using Power Buyer to determine where to put their generation, how much exposure they want to have in the day ahead on a given day. And it's very easy for us to kind of put a business case together for them or help them kind of build that business case by looking even down to the nodal level of what would the impact be if you were using Power Buyer over the last 12 months. How much additional revenue would you get per megawatt hour from your assets? So, that pretty much covers what we wanted to say. A few key messages here. One is, ERCOT really is kind of unique in North America in terms of having this large DART spread. We think it's here to stay, and really the question then becomes, what can you do about it? Do you simply move along that spectrum of blending day ahead in real time, or do you identify optimum hours when to go day ahead or real time using a tool like a Power Buyer? If there is interest, here are the contact informations for myself and Susan. We'll be happy to provide you more information as well as schedule a complimentary trial. Obviously, this time of year, sometimes it may be prudent to wait until January, but contact us and we can kind of figure out a time that works out. And we did have a couple questions that came in on the webinar that I did want to get to. One of them was, will we be making the slides available? Answer to that is yes. We'll send out a PDF to everyone on this call with the slides that we just went through. And Susan, did you have any additional ones?
Yeah, I had two others come in. A couple folks asked if we covered other markets.
Right now, we only offer Power Buyer in ERCOT, but as I think you saw early on in the slides, we do offer Power IQ, which actually is a much more granular price forecasting and congestion analysis and so forth in all the other ISO markets. But we will be rolling out a Power Buyer service for other markets, starting with PJM in the target is March of next year. So March of 2013, we'll have Power Buyer for PJM.
And finally, Hudson, someone was asking, what's the source of our wind forecast?
I can handle that. Basically, we have a proprietary wind model with a dedicated wind forecaster. And we actually have our own wind product as well, and our wind forecast goes out a week. So one of the benefits of Power Buyer is, you do get the next day wind forecast incorporated into our model, so you do get the benefit of actually that wind forecast. And that wind model, is built. It has every wind farm in Texas, and we can actually see the specific wind forecast at each wind farm, which really helps out with congestion analysis, especially out in ERCOT, where so many localized constraints out in the West are driven by, line outages and, in particularly, the output at certain wind farms. So we do have our own wind model with a dedicated wind forecaster that provides that.
All right. Well, thanks to both Eric and Hudson. And again, thanks to everybody for joining us today. Feel free to reach out to us with any additional questions or to set up a trial of ERCOT Power Buyer or our Power IQ services. So thanks again.